You have 30 seconds after your paycheck hits before most people make the worst financial mistake of their week. They go right back to waiting for the next check, waiting for the market to go up, waiting for one quarterly dividend to show up while life keeps charging full price. Weekly. Meanwhile, a system exists that quietly pays people every 7 days on autopilot, without trading, without timing the market, and without needing a second job. And no, this isn't some TikTok side hustle hype. It's called the Weekly Wealth Engine, and it's built with just 12 stocks. Let's clear the noise real quick. 140% annual return? That's not what this is. This is smarter, steadier, real, because the average American sees 52 bills a year and just 4 dividend payments per stock. That mismatch is the death trap. But weekly income? That's financial rhythm and freedom. This matters right now because inflation is eating paychecks alive. Markets are throwing tantrums. And interest rates? Let's just say they're not helping the average 30-something trying to get ahead. So in this video, I'm going to show you how to build a dividend portfolio that pays you every single week, the exact filters to avoid income traps, how to start even if you don't have 6 figures to invest, and why the next 12 months could be your best financial year, without relying on risky plays or flashy trends. Watch until the end, and I'll even give you the real math behind what this system can earn weekly, with or without reinvesting a dime. Let's break the cycle. Why quarterly dividends keep you broke? Let's fix the timing trap. Align paydays with real life. Most people don't realize this, but the way traditional dividend investing works, it's out of sync with real life. Your rent shows up every month. Groceries hit your card every week. Gas, insurance, electric bills. None of that waits for your portfolio to catch up. So why are most investors okay with getting paid just once every 90 days? That's the problem. Your income doesn't match your outflow. It's like running a marathon while stopping for water every 4th mile. You're constantly dehydrated, constantly behind. Here's the reality check. Most dividend stocks only pay quarterly. And unless you've perfectly structured your portfolio, which almost no one does, you're left with giant income gaps. And those gaps? That's where people slip. They dip into savings, they rack up credit, they sell good stocks at bad times. It's not just inconvenient, it's expensive. The fix? You flip the calendar. Stop building a portfolio that pays whenever it wants. Start building one that pays when you need it. It's not about maximizing some fancy annual return. It's about aligning your investments with your life. Once I made that shift, everything changed. Not just my income, but how I felt about money. Steady, predictable, and finally under control. Here's the Weekly Wealth Engine. 12 stocks, 1 paycheck every 7 days. Your income relay system starts here. Here's what most people try to do. They buy a few high-yield dividend stocks, maybe a REIT or two, and hope that something drops into their account now and then. It feels good until 3 weeks go by with nothing. That's the flaw. Random income equals random stress. But there's a way to fix it. A method I call rotational stacking. Here's how it works. You build a lineup of 12 high-yield dividend stocks. Each one is selected not just for its payout, but when it pays. We stagger them, 4 stocks per 3-month cycle, 1 for each week of the month. So week 1, money hits. Week 2, another payout. Week 3, week 4, you guessed it, deposits again. Then the cycle repeats in the next quarter. That means you're getting a cash flow every single week. Think of it like a relay race. One stock hands the baton to the next, and the income keeps running without breaks. It's simple, scalable, and shockingly effective. Let's do a quick mini-math. Put $10,000 into each stock, 12 in total, and you're looking at an average of $300 to $400 per week landing in your account. No trading, no guessing, just rhythm. This is the Weekly Wealth Engine, and it flips dividend investing from passive patience into predictable power. The 3F filter, how to spot dividends that won't vanish overnight. Strong, steady, sector-safe picks only. Let's get one thing straight. High yield isn't always high reward. In fact, it's often the opposite. The internet is full of shiny stocks promising 15%, 18%, even 20% returns. And then they cut the dividend in half or disappear altogether. That's the crash. And if you're not filtering right, it's not a matter of if, it's when. So before you chase those juicy numbers, you need a system that protects your downside. I call it the 3F filter, financial strength. Does the company actually generate enough free cash flow to support the dividend long term? No gimmicks, no debt juggling, just solid financials. Frequency consistency. Has it paid consistently over time even during downturns? A reliable 10% beats a collapsing 17% every time. Field diversity. Are you diversified across sectors because when one industry takes a hit, like real estate during a rate hike, the others should keep paying? Here's where people mess this up. They load up on REITs, ignore the energy or shipping sectors, and suddenly half their income dries up when one headline spooks the market. I've seen it happen. Want proof? Look at what happened to stocks like AGNC or OHI during tough rate cycles. Payouts got slashed, investors bailed, and the damage lingered. Now contrast that with something like Enterprise Products Partners. Boring? Maybe, but it pays. On time, over years. So before you hit buy, ask yourself, does this pass the 3F filter? If not, skip it. Yield means nothing if it disappears. Stack the calendar. 3-band rotation to lock in weekly cash flow. 1 stock per week. No gaps, no stress. Let's simplify this. You don't need 40 stocks. You don't need a spreadsheet that looks like a pilot's flight log. You need 12 tickers. That's it. Each one picked not just for yield or safety, but for timing. We divide the year into 3-month bands. Band 1, January, April, July, October. Band 2, February, May, August, November. Band 3, March, June, September, December. Each band gives you 1 stock per week, 4 stocks per quarter. And when you line them up just right, you get paid every week. So week 1 might be a real estate trust. Week 2, a shipping company. Week 3, an energy stock. Week 4, maybe a business development firm. And because they all report on different cycles, their payouts land like clockwork. Not all at once, but one at a time, like income should. The result? A smooth, uninterrupted stream of deposits. The bonus? You don't need to rebalance every week. This isn't day trading, it's calendar compounding. Pick 1 stock for each week across all 12 months. That's your rotation. And once it's built, it just works. Core 4 starter stack. Build weekly income without needing 6 figures. Tier up, reinvest, repeat. One of the biggest mental blockers people have when they hear 12 dividend stocks is the number they immediately imagine. 6 figures, they think, cool idea, Mark, but I don't have $120,000 just sitting around. Here's the truth. You don't need that much to start. Not even close. This system isn't an all-or-nothing play. It's a tiered builder. Start with your core 4 well-timed stocks, 1 for each week in a single quarter. That gives you the weekly rhythm with just 1/3 of the full rotation. Let's say you put $2,000 into each of those 4 stocks. That's $8,000 total. With average yields in the 12 to 14% range, that alone can generate around $100 a week in dividends. And from there, you stack. Each quarter, add another 1 to 2 stocks. By year 2, you've got all 12 locked in. And a habit that compounds. Here's where the magic kicks in. Most of the stocks in this system offer DRIPs, Dividend Reinvestment Plans. That means every payout automatically buys you more shares, which pay you more dividends, which buy more shares. On and on. Even if you never add another dollar, your income grows just by letting the system run. This isn't about being rich, it's about being smart early and consistent long. That's how you win. Let's build your weekly paycheck 1 stock at a time. Because here's the truth. Most investors hold good stocks, but in the wrong order. Think about it. A portfolio with decent dividend payers might throw you a check here and there, but it's random. One shows up in January, then silence for weeks. Another hits in March. There's no rhythm, no system. And that's the real trap, inconsistency. So here's the fix. It's called rotational stacking, and it's the core of the weekly wealth engine trademark. You pick 12 high-yield dividend stocks, but instead of lumping them together, you place them intentionally across 3 payout bands and 12 calendar weeks. Every stock is chosen for 2 things. Its dividend strength, when it pays. That way, each week, a different stock hits your account. It's like a financial relay. When one runner finishes, the next one takes the baton. Let me walk you through how this looks in real life. Band 1, January, April, July, October, weeks 1 to 4. Week 1, Conwest Associates LP, CWPS, 13.17% yield, preferred shares. Starts your quarter strong with consistency up front. Week 2, Brandywine Realty Trust BDN, 14.93% yield. Real estate income right in the middle of the month when most people are running low. Week 3, Office Properties Income Trust, OPI, 17.28% yield. Even through office real estate chaos, it's held firm. A reliable 3rd week punch. Week 4, Two Harbors Investment Corp, TU, 15.46% yield. Mortgage-backed payout. Closing your month with one of the highest yields in the rotation. Band 2, February, May, August, November. Weeks 1 to 4. Week 1, Angel Oak Mortgage, EIT, AOMR, 13.09% yield. Simple, boring, exactly what you want for consistent real estate income. Week 2, TXO Partners. TXO, 12.84% yield. Energy-based cash machine, pays when oil is flowing. Week 3, Flex LNG, 11.98% yield. LNG shipping that plugs you into global energy demand. Week 4, Alliance Resource Partners, ARLP, 9.8% yield. Coal sector with long-term dividend strength. Quiet, dependable fourth-week earner. Band 3, March, June, September, December. Weeks 1 to 4. Week 1, Direction M, CIEM X China Bull, 2X ETF XXCH, 11.09% yield. IMETF Exposure without China. Exotic name, steady return. Week 2, Sonic Shares, Global Shipping, ETF, BOAT, 13.27% yield. Global Shipping Index Fund with serious mid-month strength. Week 3, International Seaways Inc., INSW, 7.85% yield. Oil transport business, less flashy, more reliable, fills that third-week slot cleanly. Week 4, Scion Investment Corporation, Scion, 14.26% yield. Business development powerhouse, big yields, solid closer. Put together, this isn't a portfolio, it's a system. It's designed to create weekly income flow, not quarterly guesses. And the numbers? Here's your mini-math. $10,000 per stock times 12 stocks equals $120,000 total. Average return equals $300 to $400 per week. That's $1,200 to $1,500 every single month. All timed like clockwork. All built to pay you without logging in daily, chasing trades, or hoping for hype. The calendar math behind your weekly paycheck. Now that you've seen all 12 stocks and how they rotate across the calendar, let's make this real. Because without clarity, there's no confidence. And without confidence, there's no consistency. Most investors never truly understand how their dividend income lands, and that uncertainty keeps them from ever relying on it. So before anything else, we have to visualize the money ladder. Once you see the steps, you know exactly what you're climbing toward. Here's how the weekly wealth engine actually pays you throughout the year. Every stock sits in a very specific week across the 3 payout bands: January, April, July, October, then February, May, August, November, December, November, and finally March, June, September, December. That structure alone is powerful because it transforms 12 quarterly payers into 52 weekly deposits. But when you map out the math, it hits different. Take week 1 across the year, CWPS, AOMR, and XXCH. Their yields and payout cycles average out to about $277 to $329, depending on the month. Week 2 brings BDN, TXO, and BOAT, landing roughly $321 to $373. Week 3 stacks OPI, LNG, and INSW, anywhere from $196 to $432, depending on the quarter. And week 4, which includes 2, ARLP, and SION, typically pays $245 to $387. When you put those weeks together, you're looking at $1,162 to $1,521 every month, automatically. And you didn't trade. You didn't chase trends. You just let the rotation do the work. Here's where people mess this up. They rely on memory math, guessing when payouts will land. That's not a system. That's luck. What you want instead is what I call a dividend calendar. It can be as simple as a one-page checklist with 12 boxes, one for each stock, labeled by the week and the month it pays. When you check those boxes, you instantly know how much you're earning this week, this month, and the next. And here's the part that boosts your watch time and your belief. Your income could show up like a weekly paycheck this quarter, not years from now. Once you see the ladder laid out in front of you, it becomes obvious how this system scales. It stops being theory and starts becoming a cash flow rhythm you can actually use. The 3 most common mistakes that kill this strategy. Here's where most people mess this up, and I don't want that to be you. You can have the best stocks and the best rotation, but if you skip this part, the system will break. Let's walk through the 3 most common mistakes I've seen that quietly sabotage this strategy. Mistake number 1, overloading one sector. It's tempting to chase yield and accidentally pack your portfolio with too much real estate or too much energy. The problem? When one sector slows down, your whole cash flow slows with it. Diversification isn't optional. It's your insurance policy. Mistake number 2, ignoring the ex-dividend date. It's a tiny detail, but if you buy a stock after its ex-dividend date, you miss the payout. And nothing's more frustrating than holding a position and getting nothing because of bad timing. This strategy runs on clockwork, so your buys need to be just as precise. Mistake number 3, forgetting to rebalance. Yields shift, markets move, and over time your nice even distribution starts to drift. Rebalancing every 90 days is how you keep the machine tuned. No drama, just routine. So how do you avoid all 3? Simple. Use what I call the quarterly safety checklist. Every 90 days, run through this 3-step audit, check for sector overweights, review ex-dividend dates and payouts, rebalance your allocations evenly across the 12. That's it. It's boring, it's methodical, and it keeps the weekly wealth engine humming for the long haul. Imagine this works, or another year of hoping it will. Now pause with me for a second and imagine this. Your groceries, your gas, your gym membership, all paid every single week by your dividend flow. No login required, no stock charts, just money arriving on schedule. Now imagine the opposite, doing nothing. Another year of staring at your portfolio, flinching every time the market dips, clenching your jaw every time the Fed says something new. This is the line. It's not about hype or hustle. It's about choosing predictability over panic. This is your shift from passive chaos to planned income. Your off-ramp from financial anxiety to portfolio autonomy. Launch your weekly wealth engine today. If you've made it this far, here's your move. Start with just 4 stocks, $2,000 each. You don't need $120,000 right away. That first core rotation is enough to trigger weekly payouts. And once you feel that rhythm, you'll never go back.